Hi, I'm Nick from Coin and Paper, and today I want to compare mutual funds with index funds and ETFs, exchange traded funds. So all three could fall into the category of mutual funds. And mutual funds is where you're investing in a group of stocks. So with mutual funds, you can pick different types depending on the goals and the objectives of the funds. Now within index or mutual funds, you said that there's index funds, and an index fund is a mutual fund. The only difference is you're focusing on those indexes, like the S&P 500, the NASDAQ, Dow Jones Industrial Average. So these are different portions of the stock market that the media uses as benchmarks and investors use as benchmarks just to gauge how the market is doing today. So these index funds just mimic those things, and so it's a good way of investors to save money in mutual funds. Because as you go down the chart here, or think about the funnel from mutual funds to index funds to ETFs, the fees differ, all right? Because the way that they're managed is slightly different. With the mutual fund, you have the manager, the fund manager, looking at different stocks and trying to buy the best stocks he or she thinks are going to do the best, and then at the end of the year hope that that person, their mutual fund, beats the market. So they want to be winners. They want to do the best they can compared to everyone else. So with all that buying and trading comes more fees because they're highly active. So although in all three of these, you as the investor are a passive investor, so you just buy it and kind of sit back. With a mutual fund, starting from the top, the manager there is very active, trying to beat the market. But what we have found, or we as being the researchers out there, have found that a lot of fund managers actually have a hard time beating the market. So even though they're having all these fees, they're not really beating the market. And when we say beating the market, again, now it kind of comes into play here, they're not beating the indexes. They're not beating the benchmarks. So with that said, people are now starting to invest more in index funds because one, they're cheaper, and the reason they're cheaper is because there's a lot less thinking and research. Because the index fund is already kind of established with what companies go in there, so now the manager of the index fund, all they have to do is buy the same stocks in the index and just try to mimic it. So basically at the end of the year, they just want to equal the same percentage gain or loss that was in that index. So right there, index funds are cheaper than mutual funds because there's a lot less trading going on. And what investors are finding is the benchmarks usually do better than the active funds anyway, or the active managers, that is the mutual funds, the regular mutual funds. Now the third and newest type of investment under the same category here of mutual funds and even index funds are ETFs. ETFs are exchange traded funds. So like a index fund, they focus on an index. But what's different about them than say the mutual fund or regular mutual fund is how they're traded. So they trade more like stocks. And a mutual fund trades where you can only really buy it once a day and you get it overnight. So the price you pay is the price that the mutual fund closed at. And then you have those amount of shares the next day that you ordered. And the fee for a mutual fund or index fund is generally maybe, I don't know, 1% an average, so it all depends on what it is. A mutual fund could be 1%, an index fund, since they're a little cheaper, could be 0.10%. So already you're seeing a big savings from the manager having to think less by just mimicking an index. Now the ETF, since they trade more like stocks, the fees are very low. However, you're paying commissions. And the commission you pay every time you buy or sell it, because you can buy, instead of buying it only once a day, like stocks you can buy now, you can sell it 5 minutes from now, you can buy more 10 minutes later and sell more 15 minutes later. So each time you do that, it costs $10. So with that said, if you're going to do a lot of buying of ETFs, then you're probably going to pay more in the short run or the long run on commissions. But the convenience though with it is it's a lot easier to go in and out of, just like stocks, and pretty much that's the main difference between ETFs and index funds. But all three fall into the category of investing in many stocks, and you as an investor would be more of a passive investor where you're focusing on a group of stocks rather than just having an individual company. So it is very convenient and a good strategy to have mutual funds, index funds, or ETFs.